Hello, everyone. Okay, forecasting. So we're going to take the financial statements that we've had from what we called, which has now changed its name to Ninja Throwing Stars Company. They focus on creating ninja throwing stars that all of us financial ninjas can appreciate. So here, what we're going to do is we're going to do some basic forecasts. This will probably be a series of videos, but I guess that there's two things we're saying here. One, we're going to keep this really simple, right? Let's put that at the top. Keep this really simple, okay? And is, two is that this is a model. We will make assumptions and play a guessing game. All right, now that's important to note. It's also important to keep in a font that you can see. It is important because this isn't exactly science, right? This is a bit of art and science in how we actually do this, all right? So the science part is where we go in and we say, well, what do we know about previous years? How do we estimate what the growth is going to be? What will be appropriate measures that we can look at for estimating how much cash we'll need, what the accounts receivables will be, inventories on hand, what will be our cost of goods sold? Can we decrease it to a certain point? We can look at that pretty scientifically with a lot of these ratios that we did in the first videos, right? Down way back here when we were still a fake company and before we became ninjas. And in that time period, we did all these 31 ratios that now are going to come in really handy when we start going through and looking at what we're going to forecast. So before we get into actual forecasting, I'm just going to show this really quick, right? That here is what we are, here's what we're doing. So we'll make some assumptions. Well, actually, first let's rewind. So you'll see that we have 2003 to 2007. Okay, now these are actuals, right? Let's write that in there. Actuals. All right. So these are actual statements, and then what we're going to have over here are forecast. And you can call it pro forma, you can call it forecast. It really doesn't matter. The point is that you know that this is not actuals. And what that means is if actuals, we actually recorded that. Forecast means that we're looking at it into the future, right? We're just making assumptions, right? So in this, we're going to keep it simple, all right? Really simple, so simple that we were not even going to spell words right. And we're going to play a bit of a guessing game. All right, so we would start off and say, some high-level things like how much are we going to grow in sales, right? So here I make an assumption, right? This is kind of me writing in my notes on the side. You can do this on a separate sheet. You can do this on the bottom. Down here, you can do it over to the side like I did. I just did it right here because it's easier for you to see. So we have our assumptions, and then we put our inputs, right? So grow at 5%, and then I put the 5% over to the side like this because I'm going to use it, right? And inside these cells here. Now I'm going to come back in another video and we'll actually go through a few steps in a process to populate this, but I just want to talk a little bit about the what we're going to be doing here, right? So what we're going to do is first, right, we're going to go through and identify what is going to vary with sales, right? So the first thing we're going to change is going to be sales. This is the top line direction of where the company is going. Will we sell more or less Ninja Throwing Stars? And then what we'll do is, once we've identified that top line, what's going to grow, we're going to go through and identify, well, what other accounts in this financial statement, in this pro forma, what is going to change with our sales, right? So we know that cost of goods sold will obviously change with sales because it's the cost of the inventory that we're selling, right? It's how much we pay to get there. Depreciation, we know, probably will not vary as much with sales. That will depend on assets, like I wrote over here in the margins. SG&A, so that's sales, general administration expenses. That is something that could vary with sales, but not as much as say cost of goods sold will. interest expense, that won't. That is a function of debt, right? Over here, it's interest on debt. So if we take on more debt, maybe because we're increasing our assets, then we would see that rise or fall. But otherwise, it'll just be a function of how much debt we have in the books. Income taxes, of course, that will, but that's just because we're going to multiply whatever we make times the 35%. And then obviously net income will, but again, those are just, these are calculated functions that are automatic, right? So, everything I'm highlighting right now, this is going to just be calculated the same as always, right? So gross profit is always going to be our sales minus our cost of goods sold and depreciation, right? Our operating profit is going to always be our gross profit minus our SG&A. Our interest expense is going to be calculated as a percentage of debt. Our profit before tax, or earnings before tax, we should call that, is going to be nothing more than our EBIT minus our interest, and our net income will be our earnings before taxes minus our taxes, right? So we can already get a big chunk of our work done for us, just like that, right? And this will automatically populate in the future. So I'm just going to change this one thing really quick. Let's change this to earnings before tax, call it EBT, and then we'll come back in another video and look at going through each of these and talk about the assumptions we made and start filling out the sheet. Okay, talk to you soon. Bye.